The assumption sections in the program are very important to tell the program how to both calculate and display data. There's a number of assumption sections throughout the program. The most general project assumptions is the top one. This is the highest level assumptions for the program. Things like entity type, financial period ends, whether you want to display all balance sheet periods or just the most recent, or whether you want to calculate equity or enterprise value. There are a number of controls on the assumption pages that you need to become familiar with. The first is the radio button. Just select the option that you'd like. To enter a date, you can either select the drop-down calendar option and pick a date, or you can type directly into the control. But to type directly into the control, delete the number first and then re-enter it. So let's walk through all the assumption sections in the program so you know where they all are. The next assumptions is under Setup. There's also a drop-down control that will allow you to select from specific kinds of items. Type of financial statements, for example, is a drop-down control. Remember, the assumptions that you select on the assumption pages affect how the schedules look and calculate. For example, let's take a look at the ownership section. You'll notice there's a column for preferred shares outstanding and non-voting shares. If we go back to the assumptions page and uncheck these and go back to ownership, you'll notice those two columns are gone. Some of the assumptions only affect the report. In other words, an assumption like single or plural only affect the report writer. This does not affect the valuation itself. The next assumption section is under financial statements. The first option here is whether you want to show out-of-balance indicators or not on the balance sheet. If you have a partial period, you can select here how you want to annualize it. You can either not annualize it, do a pro rata percentage, use a sales cycle, use trailing 12 months, or intermanual annualization. There's an option here to include COGS and inventory in the financial statements. Simply check and uncheck to apply this option. If you have a subchapter S or partnership, you may want to have no tax lines. If you select no tax lines, you'll notice that the tax effect pass-through also applies. You see that the adjusted balance sheet option is disabled. It's grayed out. The reason it's grayed out is we only input a single balance sheet for this project. Under the general project assumptions, we selected that. However, if we selected to input all the balance sheets, we could elect to display either all of the balance sheets to adjust or only the most recent one. You can also elect to show or not show summary statements. The next assumption section is under financial analysis. Here you have a number of options that set up the comparisons. You can select whether the peer comparisons are calculated based on adjusted or historic statements, and you can select whether to show RMA, IRS, custom comparison, or multi-year data. And under RMA data, you have this option of selecting which data comparison you want to see, upper, median, or lower quartiles. The next assumption section is under Appraisal, Premiums, and Discounts. There's only one option here. It's whether you want to select the mean or median for the marketability discount study schedule. Under Assets and Liability Adjustments, there's an assumption schedule. You can select whether excess assets are calculated based on RMA, IRS, or a custom comparison. You can also select whether a holding period applies for built-in gains. Under Asset Approaches, you can select the level of control, minority interest discount or no premium discount. You can select whether to apply a marketability discount and to apply built-in gains. The assumptions pages under the income approaches have the most detail. For example, you can select which earnings base you're using. There's a number of earnings bases to choose from. You can select whether you're using a debt-free or invested capital approach. You can calculate ongoing capacity a number of different ways. And the rate calculation is also selectable. You can select whether you want to capitalize against year 0 or year 1. You can apply an industry risk to the build-it model, and you can select to use the mid-year convention. This is the schedule where you can select a control premium or minority interest discount, or no premium or discount at all. You can also select whether to apply a marketability discount or apply excess and non-operating assets to the method. You'll notice that if you apply excess or non-operating assets and you have a control premium or minority interest discount, it allows you to apply that premium or discount to the excess or non-operating assets. The program's smart and will only allow you to select options that are possible. If you have a marketability discount, you can apply it to excess and non-operating assets. Notice, if you turn off the marketability discount, the option to apply it to non-operating assets disappears as well. You can also apply premiums and discounts to the sensitivity analysis using the schedule. Since the assumptions are so similar for all the earnings approaches, we just want to show you where they are rather than go through each method. So there's an assumption section under multi-stage growth. There's one under summary DCF. And there's also one under detailed DCF. Once again, these assumptions are very similar, almost exactly the same. Capitalization of excess earnings is the last income approach that has an assumption page, and this is very much like the other ones. The commercial data sources all have assumptions under them. For BizComps, you can select historic or adjusted financials to use as the base. You can also select the mean or the median multiple to use. You can select levels of control, marketability discounts, etc. All of the commercial data sources assumption pages are the same. There's assumption pages under the other data sources as well, and they're almost exactly the same as the commercial data sources. So just know that each one of the options under other data sources has an assumptions page. The next assumptions page is under conclusions of value. You'll notice it's all disabled. This is because under the general project assumption, we selected to use valuation method assumptions rather than conclusion of valuation level. If we selected the conclusion of value level, these would all be enabled. The last assumption section in the program is under sanity checks justification for purchase, and there's only one option, the number of future years in the post-sale cash flow to calculate. It's a drop-down box and you can select the number of years. This is the end of the assumptions tutorial.